Now, the money and the flows, this is retail investor money in the Chinese market. I think they make up about 90% of the trades in the Chinese markets. Households are flush with money, but where are they? Is it because they have a lack of assets to buy that they're getting into the equity market? Or what's the thinking behind this?
Well, I think you're partially right, meaning that there are limited options when it comes to where Chinese can deploy their capital. And right now, I don't even think there's been much real retail appetite into the market. I think we probably have seen the beginnings of that started last week. Most of the gains prior to that were coming from, we can call them Chinese smart money investors, institutional investors, perhaps, like insurance companies. But if you go back, even 18 months ago, when the stock market had a massive correction after this so-called snowball correction, investors at the time viewed property as being toxic, equities as being toxic, and essentially drove all of their capital into fixed income, to the point, in fact, that the rapid deceleration and decline in yields over 2024 we believe was the outcome of actually flows into fixed income. You buy more fixed income, the prices go up, the yields go down. And, Emily, what's fascinating, look at the 10-year bond yield over the course of the last month. It's moving in the opposite direction. It's beginning to move higher. And again, still in a deflationary environment. But why would that be the case? More than likely, these very same investors are now unwinding their fixed income investments, long-term bond funds, money market funds, bank wealth management products, and they're shifting those proceeds into the stock market. So it's not just that the stock market's going to move higher moving forward, in our opinion. We actually think yields are going to continue to move higher as well, just based off of selling of fixed income securities.
Are foreign investors interested in a Chinese stock? We heard from the latest filings from Bridgewater Associates. They have liquidated 13 of their Chinese companies' exposure. How do foreign investors view China?
Well, China continues, at least China, let's say, onshore, RMB equities, most hated trade in the world. And I've got to be honest, Emily, I kind of laughed where 2 weeks ago, I was talking with clients with regard to the China trade, and nobody wanted to listen. No American investor wants anything to do with China. And then you fast forward 10 days later, and all of a sudden, everybody's talking about China being some sort of bubble. That's the fastest, I think, elevation of a market to bubble territory than I think I can imagine. And it's, granted, China, but valuations might be stretched, but I could argue that valuations are stretched in virtually all markets at this point in time. So, it's tough to say. My guess is you would need probably another 20% rise in the Chinese equity markets before global, especially American investors would stop and say, okay, let's finally start allocating and putting some money to work in China.
Now, if they do and when they do they do this via the Hong Kong market? Do they go in by the northbound stock connect?
I would suspect number one, any group that is already sort of saying we need China allocations will almost always go into Hong Kong. I can understand the rationale. I still believe that the Hong Kong equity market and the Chinese equity markets are two very different asset classes. But more than likely, you'll continue to see a preponderance of, again, let's just go with the Americans. They're the best sort of benchmark. They'll go to Hong Kong, and then probably you'll know you're nearing a peak in this cycle when those very same Americans begin to pile into the A-share market through northbound stock connect or the FII programs. But again, I don't suspect we're going to see that at any point in the near future. That may be later this year or perhaps into 2026.
Now, the A-shares lag the Hong Kong market. You expect any chance for a re-rating?
A re-rating for the A-share market, is the question?
Yeah. Mm-hmm.
Yeah. I think this is the whole issue with regard to flows. I think if I haven't stressed this appropriately, let me do so now. Fundamentals certainly are important, but I think at this stage and what we're seeing in the rally, it's all about liquidity. And while there's been an enormous amount of focus in the last few days on how much China has in terms of savings, it's like $22 trillion worth or some ridiculous number. It's really the allocations that the Chinese retail investor has in other types of fixed income, short duration fixed income product that we're anticipating are going to be redeemed and then reallocated. So you could see a very quick, if you will, re-rating in the Chinese onshore market just on liquidity alone. The question will then become, how long can that last and how sustainable will it be? And dare I say, is this time different? I've been around for so long. I've seen 2015, I've seen 2007. China, second largest economy in the world, no doubt. But in terms of its market, it's still an emerging market and has emerging market tendencies. So we're just going to have to wait and see how this all plays out in the next several weeks and months.